Okay, section 3 for today. Let's talk about the 2008 financial crisis. And as I said, we're going to talk about this in order to put into some context a brief discussion about what's going on today with the pandemic and what are the potential ramifications of that. So let's talk about the 2008 financial crisis. As I see it, there's three primary factors that drove the 2008 financial crisis. Many of these you are probably familiar with, but it won't hurt us to talk about them again. First off, financial innovation, and particularly securitization in financial derivatives and shadow banking, these things that we talked about before, right? That the growth, first off, the growth of the mortgage-backed security market, right? So many mortgages were being securitized and turned into bonds because there was such a huge demand for these bonds by savers. They looked safe as houses and they gave very high interest rates. There's such a demand, in fact, for these bonds that more and more banks were lending out money to people who really did not qualify, or they certainly wouldn't have qualified in the past, and they probably shouldn't have qualified at the time for a new mortgage, right? And this is what we call the subprime market. Subprime market is a kind of nice way of saying people who shouldn't have qualified for loans, right? They were risky individuals who may not have had long credit history, may not even have jobs or permanent jobs. And so these were people who just barely could be justified in lending money. Now, on one sense, the banks could justify this because they thought, well, even if the person doesn't repay, we'll still get the house, right? In other words, when home prices kept on going up by 10% a year, even if someone defaults on their mortgage, that's okay because we'll still get the house and the house will have appreciated in value and we'll still be able to get our money out of it, right? But all that changed when home prices began to drop, because what happened was that a lot of people now saw that these homes that they took out a $200,000 mortgage on were now only worth $150,000. Why should I pay $200,000 for something that's only worth $150,000? I shouldn't. I should just give this house back to the bank. And by giving it back to the bank, banks experience big losses. And a lot of these mortgage-backed security bonds no longer were able to get the interest payments to pay to their bondholders, and the whole thing crashed like a deck of cards. So just to kind of see or get some examples of what was going on in the subprime market. Here's just an example of some things that you saw in the newspaper. Home loans made easy, right? Low monthly payments, 4 out of 5 approved, no upfront costs, right? In other words, no down payments, 1% start rate, right? No documentation for your stated income, 100% finance available, interest-only loans, right? Paying loans that only required you to pay off the interest, not any principal. Debt consolidation, you could even put in debt, credit card debt, into your home loan, right? I mean, these are just kind of crazy lending practices. Here you see the growth of the mortgage-backed security market in the US, and you can see how it really took off in 2002. At the peak here, almost a third of all mortgages were subprime mortgages, right? So, a huge proportion of these mortgages that took place in 2002, 2003, 2004 were this subprime, right? Here you can see, this is looking at subprime mortgages, right? So in 2005, 2006, over a third of all mortgages were subprime, right? And here's looking at the percent of these subprimes that had very little documentation, right? Look at almost 60% of the subprime market loans made in 2007 were no documentation. Sometimes these loans were referred to as ninja loans, NIJA loans, meaning no income, no job loans, right? Even if you didn't have any income or a job, you were still able to qualify for these things, right? Crazy, right? Crazy, right? Here's the percentage of home purchases in the US with a down payment of 3% or less, right? By 2007, almost 40% of homes had down payments of 3% or less. And so what this meant was that there was a huge portion of people who had almost no money invested in their house, right? In other words, they bought a $200,000 house with a $200,000 mortgage. Once again, banks thought, well, as long as home prices go up by 10% a year, we're still covered. But what happens when home prices drop by 40%? Now you saw homes that were worth $160,000 but had, as I said, a $200,000 mortgage on it. This essentially created what we could call a put option, right? A put option for homeowners. And by a put option, I basically mean that now homeowners could make $40,000 by just giving their underwater houses back to the bank, right? And so in some sense, it was a form of Ponzi finance, right? That the debt payments that many people took on their houses were less or were greater than the cash flow. And so they had to just keep on borrowing more, right? And this worked as long as home prices were rising at 10 to 15% a year. But when they stopped doing that, right, no, the whole thing collapsed like a house of cards, right? And so once again, when you saw housing prices here drop by about over 30%, and you saw stock prices drop by about 50% right at the beginning of the crisis, the whole thing was cooked, right? The whole thing was cooked. Many of these mortgage-backed securities now were going to go bad. Many banks that had made loans or were holding a lot of mortgage-backed securities were going to go bad, right? The game was up. Where did all the money come for these mortgage-backed securities, right? I mean, who is buying all these things that, encouraged all the subprime lending, right? Who is buying all the mortgage-backed securities that drove the demand for making subprime loans? Well, a lot of this money was coming from overseas, right? What economists have often called the global savings glut, right? That the U.S. remains a very, very attractive place to save your money, particularly for other countries that are growing fast but don't have very good financial systems. And by this, I'm talking primarily about China, right? We'll talk about China later, but the Chinese financial system, Chinese banks are not a very attractive place to save. The Chinese financial markets, most people don't have much confidence in them. And so there's a lot of savings in China that's looking for a place to park. And to the extent that Chinese individuals can get their money out of China, they try to park it in the US. And so it was really a lot of Chinese that were buying up these mortgage-backed securities. But not just Chinese, people in Europe, banks in Europe, right? And, what was driving this to the US? Well, it's going to the US because the US is still seen as the most attractive global financial system. Going to the US because the dollar is an international currency. And then going to mortgage-backed securities because there was this belief that, these things were safe as houses, right? What was the chance that all housing markets in the US would collapse at one time, right? There's this belief that just couldn't happen. It couldn't happen. And so as money fueled into these mortgage-backed securities, it really encouraged a lot of very risky behavior. And then the third thing that I think contributed to the 2008 financial crisis is just this ignored reality of financial risk, right? Probability is not the same thing as risk, right? And these mortgage-backed securities and other financial derivatives really created a lot of unknown unknowns, right? Things that basically people in finance could not incorporate into their analysis, right? A lot of things got dropped, right? A lot of things got dropped. A good example of an unknown unknown is counterparty risk. What's counterparty risk? Well, let's say that I owned a mortgage-backed security. And then to protect myself from it going bust, I bought a credit default swap on it. And if you remember what a credit default swap is basically a contract that would pay me if this mortgage-backed security goes default. So as the bondholder, I feel like, oh, I've just eliminated all my risk, right? All my default risk, because I bought this mortgage-backed security and I also bought a credit default swap. However, I'm still at risk because of counterparty risk. And counterparty risk is, what happens if that person who sold me the credit default swap goes bankrupt? In other words, what happens if the insurer can't provide me insurance? So what happened to a lot of people is they did just that. They bought a mortgage-backed security and they bought a credit default swap from a big investment bank such as AIG. Of course, what's the problem? AIG is also making lots of credit default swaps to other people. And AIG is also issuing mortgage-backed securities. So when the mortgage-backed security market goes tank, AIG is losing so much money, now they can't pay me back on my credit default swap. And so when I thought I was protected, I no longer am. That's an unknown unknown, right? Or, to some extent, maybe you should have known this, but to some extent, how interconnected the financial system was really not fully appreciated by most people. And so, yeah, there were so many risks that people thought, oh, I'm diversified, I've gotten rid of that risk, or I've thought about this, but there were just a lot of unknowns out there, right? A lot of unknowns out there. So anyway, one of the things here, if we can move back to our handout that I show you, is you can see the spike in risk. Here's the cost of lending between banks, right? Banks freaked out, to use a technical term, as it became very, very clear that that there was a lot of risk out there that couldn't be handled. Here you see credit scores on newly originated mortgages, and look what happened, right? Basically, banks continue to make mortgages, but only to a much, much higher category of lenders. This is essentially credit rationing, right? This is essentially credit rationing. And so this greatly slowed the recovery because banks stopped lending money out, right? They just stopped lending money out. And here you can see another example of credit rationing, which is the risk premium, right? How much higher an interest rate you have to pay between a BAA bond, right, a corporate bond, and a U.S. Treasury. And you can see that this spiked by about 4 or 5% more than you did before the crunch, right? So basically panicking. One of the things that happened here was that there was a massive transformation of the U.S. financial system because so many firms failed, or to prevent failure, got eaten up by other companies, right? So 14 of the 20 largest financial institutions in the US were transformed, right? Almost 2/3 of the US financial system completely changed. 5 of the top 20 financial institutions either failed, like Lehman, or were bought and disappeared, like Bear Stearns. Some of the banks got much bigger, such as JP Morgan and Wells Fargo. They were kind of the stronger banks, and so they ended up buying a lot of other banks, right? All were forced to take government lending, whether they wanted to or not. We'll talk about that here in a moment, right? So it completely changed the US financial system, and it's contributed to what we talked about yesterday, the concentration of the US financial system, right? Because basically you took the top 20 and you moved it down to the top 15, right? And it was the banks at the very top that benefited the most from this, right? Is the banks at the very top, such as JP Morgan, which is now the largest, was not, I think it was like the 3rd or 4th largest US financial institution before 2008, but today is by a fairly decent amount the largest, right? why wasn't the U.S. crisis much worse? And this maybe is a kind of an interesting question, because you probably think about the 2008 crisis as being horrible, and it was, right? Unemployment went up to 10%, incomes fell by 10%. It was not good. Having said that, it was a lot better than the Great Depression. During the Great Depression, we lost a third of all banks. We saw output fall by 25%. We saw unemployment go up to 25%. So the Great Depression was a lot worse. Why wasn't the 2008 crisis as bad? Well, for this, we can kind of well, it sounds self-serving. Thank you, economists, because you actually, by studying the Great Depression and studying banking crises, you actually gave some fairly good advice about how you prevent a banking crisis from being worse. First off, the Fed was a very aggressive lender of last resort, right? And one of the things that the Fed did very well during the crisis is they quickly understood that it was going to be impossible to lend to every single bank, because every single bank was just too interconnected, right? They were just too interconnected. And so what the Fed decided that they needed to do is they needed to support markets, not just banks, right? And they did this a lot through buying assets, particularly mortgage-backed securities, right? Their idea was, if we can buy mortgage-backed securities, these distressed assets, and kind of provide some stability to the market, then that will allow banks to see their balance sheets stabilize and to kind of know what kind of losses they're going to have to take. Now, you might think that the Fed lost a ton of money on this, but no, the Fed actually earned billions, trillions on this, because really what happened at the bottom of the crisis, where a lot of these mortgage-backed securities were just selling at pennies on the dollar, right? Really unbelievable deals, right? Very good deals. The Fed was able to kind of cash in on this. But of course, what the Fed wasn't trying to do was, they weren't trying to make money. They were just really the only institution out there that had any liquidity, right? Just as Warren Buffett knows, it's good to be liquid, right? Particularly during a financial crisis, because that's a great time to buy. And so what the Fed was able to do is not only kind of solidify many bond markets by buying up bonds, particularly mortgage-backed securities, but they actually made some money, right? They made some money on this, and they helped banks kind of have a market, right? Particularly banks that really needed liquidity. Now they had somebody that they could sell these to, right? One of the things that happened, though, was the Fed greatly expanded its balance sheet, right? And so I think I have a handout of this. Actually, I don't know what happened. It's not in your, apologize for that. It's not in your list of handouts, but basically the Fed tripled the size of its balance sheet. So it tripled the number of assets it had. And how did it do that? By increasing the money supply, right? By basically creating money out of thin air. The Fed tripled the amount of assets that it holds, right? The Fed aggressively cut interest rates, right? So interest rates went down to zero, and they stayed close to zero for a very long time. The fiscal policy was also expansionary, right? Before the crisis, or at the very early stages of the crisis, George Bush was still president. There was a tax cut in 2007. And then in 2008, after Obama became president, there was a big Obama stimulus package, which was about $350 billion in tax cuts and about $350 billion in spending. Did this help? Well, I won't say it hurt, but I'm not sure that it helped that much. And in part, a lot of this was a little too late, right? By the time that the money was actually distributed in tax cuts, by the time that the spending actually occurred, really the worst of the crisis was past. And you might think about that here when we think about the response to the pandemic, how much more aggressive policymakers were. I think in part because we learned that a lot of the fiscal policy response to 2008 was just a little too slow. And then finally, the TARP, the Treasury Asset Relief Program, right? Where basically banks were bailed out by forcing them to allow the government to purchase capital in them. What was this capital? Well, the capital is not common stock. It was instead what's called preferred equity. And preferred equity is like stock, but with two differences. One, you don't get voting rights. So the government said, we're not going to take voting rights in what this bank does. We're just going to take equity. That was probably a mistake for reasons we're going to talk about, in part because one of the things the banks did is said, great, government's not having any say in what we do. Let's pay off our CEOs, right? And give them big bonuses, right? I mean, when you think back to it, it's crazy how some of these banks responded. But anyway, the other thing about preferred equity was it guaranteed the government a percentage return. So instead of getting distributed dividends, the government negotiated a guaranteed return. Banks had to take it whether they wanted it or not, right? This is basically kind of like everybody's got to take their medicine, and we're only offering this one time, so take it now. And so every bank had to take it, even banks that didn't want it, like JP Morgan, had to take it. Bush initially wanted to provide loans instead of capital, and it was left to the Federal Reserve to say, hey, listen, didn't you pay attention in money and banking, right? And no, I don't think George Bush did pay attention in money and banking. If you give banks loans, you've done nothing to reduce leverage. The way that you reduce leverage is by increasing capital, not increasing borrowing. And so that's why this was in the form of capital. Purchasing capital was the way to reduce leverage. TARP was $700 billion. And if you ask people how much of that money did the government get back, I would guarantee you that probably 90% of Americans would say none of it. In fact, probably you, unless you've taken some of my classes and heard me rant about this before, would say none of it. In fact, the government got almost all of it back. Right? How much did it end up costing? Of that 700 billion, we got all but 50 billion, right? A great deal. And of the 50 billion we lost, almost all of it was because of Fannie Mae and Freddie Mac. It wasn't from the banks. We actually got all of our money back from the banks. It was from Fannie Mae and Freddie Mac, these semi-government institutions that had got heavily involved in issuing mortgage-backed securities. I think you can argue that this is one of the best economic deals in history, right? We got a lot for our money, right? We got a lot for our money. And in many ways, the TARP really illustrates one of the big lessons that we've learned is that you have to take your lumps and you have to come in with a lot of money, right? If you do that, it actually makes bailouts more effective. The faster you can get it out there, and the more overwhelming it is, right? So the more that you can kind of calm psychology, the better it is. So if TARP was so successful, why is it still so unpopular? Well, I think it's pretty obvious, right? First off, there's still a lot of concern about moral hazard, right? This too big to fail. There's just this perception, and not completely unwarranted. In fact, probably many ways warranted, that many of these banks were too big to fail and they engaged in a lot of risk. And in the end, it didn't end up costing them that much. I think that the public just simply doesn't know. The public, after the crisis or in the middle of the crisis, wasn't really paying attention. They heard that $700 billion and they said, well, that's how much it got spent, right? But very little attention was paid to figuring out how much got paid back. The politics of this were just horrible, right? I think I alluded to a minute ago, that many bank executives paid themselves bonuses after they got a government bailout. And why weren't they stopped from doing it? Well, because the government really didn't think about this, right? The government was so concerned about getting cash out and trying to be an even player and not show preference that they completely really forgot about, or maybe never considered that many of these bank executives were such horrible people that they would still take huge bonuses even after getting a government bailout. And Timothy Geithner, the Treasury Secretary under Obama, said it well when he said, "We saved the economy, but we lost the public." right? In other words, they were so focused on the economics and doing what was necessary. And, it was a crazy few weeks, right? So much was going on. I think you all have the sense of this, right? Think about what was happening in mid-March here in the US, right? So much was going on. It was just almost impossible to keep up with everything. And I think too often the government of the Obama administration really focused on saving the economy, but kind of lost focus on the politics and often explaining what was going on and being transparent. So, this is my opinion, right? But I think it's an opinion that a lot of economists would support, is that history suggests that bailouts are a necessary evil. We hate them. They create moral hazard. They look horrible. Yes, they often reward people who shouldn't be rewarded. However, history shows us that without quickly, rapid, overwhelming bailouts, the cost of financial crises can be devastating, right? History also suggests the importance of prudential regulation to keep moral hazard from the future for getting out of control, right? And so that's what I want to come back and talk to in the final section of our lecture today, is we know that the US economy re-regulated itself after the crisis. And I want to talk about the new regulation that took place after 2008. And then that will lead us to a discussion about today's pandemic. Are we prepared? Is our financial system prepared for this pandemic? Right? We'll come back and talk about that in a moment.